Half the internet is convinced artificial intelligence is the biggest bubble the markets have ever seen. The other half is convinced it's the biggest breakthrough of our lifetime. And for a long time, I stayed out of this argument entirely, mostly because everyone else was already yelling about it. But the longer I watched the fight play out, the more obvious it became that both sides were arguing about the wrong thing. They're both staring at the same half of the picture: user growth, adoption numbers, revenue projections, demand. That's all anyone talks about. But demand is the side of the story that's easiest to fake, easiest to spin, and easiest to sell to you. There's a second half of this story that almost nobody's watching, and it's the half serious investors have quietly relied on for the better part of 2 centuries. Before we get into it, I just want to say, this channel is still small, and if you're finding this useful, dropping a comment with where you're watching from genuinely helps more than you'd think, and I'd love to know who's actually here. All right, back to it. That second half is called supply, and unlike demand, supply can't lie to you because it takes real money, spent up front, before anyone even knows whether the story is true. This year, the biggest technology companies on Earth are on pace to spend somewhere around $700 billion building out artificial intelligence infrastructure. Most people hear a number like that and their brain just skips right past it because it's too large to actually picture. So picture it this way instead. That's roughly $2 billion a day, every day, for an entire year. By the time you finish watching this video, several $1 million of that will already be spent. We've genuinely never watched a build-out of this size happen in real time before. But as the old saying goes, history doesn't repeat, it rhymes. And what's happening right now rhymes louder than almost anything I've studied. Here's the part that actually matters, and it has nothing to do with whether AI itself is real or useful. It obviously is. The question was never whether the technology works. Financial bubbles have almost never required bad technology to form. In fact, it's usually the opposite. The technology is often completely legitimate. Researchers who studied major innovations going back nearly 2 centuries found that a majority of the biggest technological breakthroughs in that stretch, things like the railroad, the automobile, the internet, ended up triggering a full-blown speculative bubble anyway. Being right about the technology and being right about the stock price were never the same bet. And the framework that explains why goes all the way back to Adam Smith, who wrote that when too much capital chases the same opportunity, competition eventually crushes the very returns that attracted the capital in the first place. Investors today call this the capital cycle, and it plays out in 4 repeating stages. First, a flood of money rushes toward something new and exciting. Then a boom, where everyone piles in at once, building faster than actual demand can keep up. Then a collapse, when the oversupply finally catches up with reality and prices crater. And finally, an inheritance, where whoever's left standing scoops up the wreckage for pennies and quietly becomes rich off of it. You can watch this exact cycle play out across completely unrelated industries, decades and even centuries apart. Rewind to Britain in the 1830s. The railroad was the technology of the moment, and money poured into anything with tracks attached to it, not just from professional investors, but from shopkeepers, clergy, ordinary savers who didn't want to miss out. At the peak of the mania, railway investment alone made up something like 7% of the entire British economy, and Parliament was approving hundreds of new rail charters in a single year. Then the boom turned reckless. Duplicate lines got built to towns that barely had enough people to fill a single carriage. Revenue came in far below what was promised, and by 1850 the collapse had wiped out more than half of railway share values. Fortunes vanished almost overnight, but the tracks themselves didn't disappear. Decades later, that same overbuilt railway network became the backbone of British industry, and the people who profited most were the ones who bought the wreckage after everyone else had already been burned. Fast forward to the late 1990s, and the exact same pattern shows up wearing a different costume. After telecom deregulation, Hundreds of billions of dollars flooded into fiber optic cable. Companies buried an almost unbelievable amount of it under oceans and across entire continents. Then the demand simply never caught up. The vast majority of that fiber sat completely dark and unused for years. Bandwidth prices collapsed. The Nasdaq lost the majority of its value, and some of the biggest fiber manufacturers on the planet watched their stock fall from over $100 a share down to pocket change. Yet that same, buried, forgotten fiber network is quietly part of the backbone powering today's AI boom, bought for a fraction of what it costs to lay in the ground. Push forward another decade and you get the shale oil boom. New drilling technology unlocked reserves nobody could touch before. Capital flooded in. American oil production roughly doubled in just a few years. Then the same story played out one more time. Supply blew straight past what the world actually needed. Prices collapsed from over $100 a barrel down to around $30, and more than 200 drilling companies went bankrupt inside of 2 years. 3 completely different centuries, 3 completely different technologies, and the exact same underlying mechanism driving all of them. Which brings us to artificial intelligence, the biggest version of this cycle we've ever watched unfold, because unlike railroads or fiber or oil, the entire U.S. economy right now is leaning on this one bet to keep growing at all. One economist ran the numbers and found that AI-related infrastructure spending made up a small slice of GDP this year, yet it accounted for the overwhelming majority of all economic growth. Strip AI spending out of the picture entirely, and the rest of the economy barely grew at all. So where does that leave us inside the 4 stages of the cycle? The flood clearly already happened. We are deep into the boom. And if you look closely, the cracks that always show up right before a collapse are already starting to appear. A lot of the demand being celebrated right now isn't independent demand at all. It's the same handful of companies investing in each other, funding each other, and buying from each other in a loop, where money that leaves one balance sheet quietly reappears as revenue on another. That's not new either. Equipment makers ran the same playbook during the fiber boom, financing their own customers' purchases, and then booking those purchases as real revenue, right up until the moment they couldn't extend any more credit, and the whole illusion came apart. And the cracks aren't just theoretical. One of the industry's most dominant chip makers recently posted solid earnings, but guided next quarter's outlook only slightly below expectations, a rounding error for a company that size. The market response wasn't a rounding error. Hundreds of billions of dollars in value evaporated in a single trading session, one of the sharpest single-day losses Wall Street has seen in years. That's not what a healthy, rationally priced market looks like. That's what a market priced for absolute perfection looks like. One where even a tiny miss gets punished disproportionately. There's an old line about pioneers taking the arrows while settlers take the land, and you've watched this play out your entire life without necessarily naming it. Early search engines burned through cache building something nobody understood yet. Then a later entrant walked in once the ground was proven and took the entire market. Early ride-sharing companies fought years of lawsuits and regulatory battles just to prove the model could exist at all, and then bigger, better-funded competitors walked in right behind them and scaled it. The pioneers almost never get to keep what they build. Whoever inherits the wreckage usually does. So the real question was never whether artificial intelligence is going to change the world, because it probably will, one way or another. The real question is, who's flooding capital in right now, who's about to get crushed by their own oversupply, and who's quietly positioning themselves to inherit whatever's left standing once the dust settles. That's the side of the story traditional coverage keeps skipping, because it's not loud, it's not a hot take, and it doesn't fit neatly into a headline. But it's the side that's actually decided every single one of these cycles throughout history, and it's the side worth paying attention to now.